Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, president and founder of TJ Stearns, your resource, ladies and gentlemen, for a common sense approach to planning to address the complex financial investment and retirement world that we live in. And Tim, an extra wrinkle on top of those aspects, keeping as much of our money as possible. Today, going to be talking taxes.
Well, Peter, it's everyone's favorite topic this time of the year. Unfortunately, we do have to do that, death and taxes, as Benjamin Franklin said. But basically, we're here with maybe some solutions for some people to talk about, to try to get some tax avoidance down the road, of course, legally. But I think this is, something that people are always at this time of year doing the Monday morning quarterback to themselves. I should have, I could have, what was I thinking for 2022? So it's early enough, it's just February. Why not think about some things that you could get ahead of as the year wears on?
Absolutely. Yeah. All of our favorite mail showing up this time of year, Tim, W-2s, 1099s, K-1s, and the like, basically telling us what happened last year, all that historical. And we'll be talking about maybe a strategy or two that we can do for last year, but those opportunities generally close on December 31st with just a couple of exceptions. However, what we can do is plan proactively for all the years ahead. And that's, I think, what's going to be the main topic of today's program, ladies and gentlemen. If your discussions about planning have not included specific discussions on a proactive tax strategy, you need to pick up the phone. You need to give certified financial planning professional Tim Stearns, CFP, a call for that complimentary Protect and Grow plan. Part of the protection, part of the growth, both of them, in fact, involve taxes as part of it. And I think we all want to be tax efficient. It's simply that we don't want to talk about or deal with taxes. But in order to be as effective as possible, you do need to be proactive in your planning. And again, the Protect and Grow plan, the written plan that Tim Stearns provides for listeners and viewers of this program with no cost, no obligation, certainly does address those proactive strategies that we can implement to be as efficient as possible with taxes. So give a call, 800-640-2256. That's 800-640-2256. 800-640-2256. And Tim, we have really been under the premise for more than a generation now that we will be paying lower taxes in retirement. Is it time to rethink that paradigm? Is that one of the basis for really planning proactively to be efficient in today's world?
Well, I know for a fact that when I asked that question, our tax is going to go up in retirement. After 2025, the end of 2025 is when the current tax laws will sunset or expire. Is a better way to look at them, that we should have a new tax set there for income tax. What I think is that, right now they're the lowest they've been in a long time. They're probably going to go up, right? I asked that in class, and I've never had anyone say that they're not going to. That being said, the other argument is, well, I'm going to be in a lower tax bracket, right? When I retire, because I won't be making as much money. But again, are you going to be in a lower tax bracket? I think you have two things going against you. Number one, taxes are going to go up after this sunsets. Number two, when you're in retirement, you're going to be having the same bills coming in. So that, your cost of living, your, utilities, that type of thing. Maybe you're doing, trips that you never were able to do, that type of thing where you're taking money out of qualified accounts being IRAs, 403Bs, anything that the IRS has never taxed. Well, guess what? You might be in the same tax bracket, if not maybe a little bit higher because of the taxes sunsetting.
Tim, with the inflation that we saw last year, it's not only have the line items within the budget gotten more expensive, but I was thinking back over the past decade, 2 decades, how many new line items I've actually added to my budget, how many new services and tools and technologies have been the big ones, and protections that I have to put in place, identity theft, and, you know,
Yeah.
all of those kind of things have all been added to those budgets and the line items that I've got to meet. Things get more expensive as we move on. And so even though perhaps tax rates and brackets have come down a little bit, which the big question is, are they going to continue doing that, or have we reached an optimal precipice here? But things have gotten more expensive despite those coming down. So are we ending up paying as much or more in taxes? And during our working career, taxes are sort of taken off the top for the most part before we even see our money in retirement. It's like we have to add taxes as one of those new line items to our budget, and generally one of the most expensive.
Right. Exactly. So I know what you're talking about here. I mean, basically, you know, I get my check. After I get my check, it's, you know, I've already paid my taxes and I pay my bills. Then I spend some money, and hopefully, you know, I'm able to save, right?
Right.
Well, when I go into retirement, a lot of my money has not been taxed, right? So I take money out, I pay my bills, my spending comes from my 401k, my, you know, the residual IRAs I have, and then I'm paying taxes. And so, you know, a lot of us play the Monday morning quarterback, you know, then going, man, I shouldn't have done that. Well, you know, some of the things I tell people, even nowadays, you can try to do a 401k Roth, you know, so you can put some of that money that you're paying taxes on now, you know, pay on the seed, not the crop type of thing. You know, I know in my family, it was beaten over my head that I should invest into my IRAs and my 401ks. And, you know, maybe I get, you know, the $6,000 that I put in my IRA grows to be $60,000 when I'm 60. And now I'm paying taxes on 60,000. That doesn't seem real smart anymore. So I'm just saying, you know, running the numbers, you know, you have to look at it that you want to pay the taxes now when taxes are the lowest they've been in over 60 years.
And there's some situationality there as well, right? We've got to crunch the numbers and see when it makes sense, when is an optimal time, how to create that income or withdrawals or those tax strategies. And that's a big part of what you do there at TJ Stearns, Tim, is run those tax scenarios, discuss what variables they're based on. I've seen a few of these that you have sent over for discussion on the program, and the difference in how much we're going to end up owing in taxes by defaulting and deferring versus being proactive in some cases can be hundreds of thousands of dollars, or depending where we're at in our progress, could be as much as the current balance on some of those retirement accounts.
Right. I mean, basically what you're looking at is tax preparation versus tax planning. And, you know, we're looking to maybe try to get ahead of it and be smarter, you know, so that you can actually, you know, pay taxes now rather than later. You know, we're paying all the time on a crop, you know, and the crop being taxed at the full rate. Why not look into doing an income allocation plan that actually takes into effect taxes, you know, making sure that the gross is matching the net after you've paid taxes, so you know exactly what you need to bring into the house.
Once again, that protect and grow plan, that income allocation component of it, that is going to include a discussion of and details on proactive tax strategies. So not only can you generate the income, but you get to keep more of it into and throughout retirement. And that is so important and vital to make our money last and to make the most out of it, to make the most out of the retirement tools and accounts that we have available. You need to have that proactive plan, ladies and gentlemen. Pick up the phone, give certified financial planning professional Tim Stearns, CFP, a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, really, there's been this rhetorical question that we've all sort of formulated our own answer to as we've saved each and every dollar of pay me now or pay me later. The IRS has given us that choice and option. And for most of us, we have chosen to pay later and pay on the harvest rather than the seed. And growth is our objective when we invest money, but the IRS thanks us for that goal as well, because when we've grown our own money, we've grown their money as well.
Right. I mean, they've created quite a mousetrap for us, right? That they're going to get us one way or the other. So that's why we urge people to take a look at maybe doing some Roth conversions now if they're slowing down. We just had a gentleman in the office. He's slowing down his career. He's like, I'm not going to make half of what I made last year. So we talked about maybe doing some Roth conversions. Now, we're going to visit that again in November to see where his year goes, because he does a lot of different things. But I mean, these are questions that you should be asking of your advisor out there. What are we doing to mitigate taxes? Again, I bring up the tax preparation versus tax planning. Why not get ahead of these situations instead of being mad at yourself that there's something you could have done when you were in your early 60s and now you're 80 paying taxes on a bigger tax bill.
Once again, Tim Stearns here talking about the proactive approach that we should take to taxes. They're a thorn in our side. I don't think this is anybody's favorite topic. Maybe a couple rare tax geeks out there that really dive into this, but for most of us, this is something that we would rather ignore and think about only when it's time to file. But we need to be a little bit more proactive with it in order to make the most out of our opportunities to control that tax liability. Tim Stearns takes that approach when he puts together that Protect and Grow written retirement income allocation plan. Pick up the phone and give a call if you would like to take up the opportunity to have a discussion. A couple quick questions over the phone. You can get direct answers or the complimentary review and retirement planning strategy session, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, taxes not only have changed over time, but they really have probably our biggest change, a real transition. Once we get into retirement, taxes are handled much differently. That needs to be thought about prior to entering into retirement. Can you sort of explain the three buckets and where we can keep our money?
Sure. It's funny you bring that up, because that's one of the things we do in our retirement classes. So there's three buckets that we can put our money in, right? The first one would be taxable, right? So I have a lot of clients, prospects, people in the classes, they have a taxable account where they're, checking, maybe it earns a little bit of interest, right? They have a stock slush account, that they buy the latest whim. They did their cryptos in there and stuff. Basically that didn't work out so great for many of them, but they're kind of doing, they pay as they go. We'll call that the taxable account. All right. Then we, of course, have our tax deferred account, right? Which would be our IRAs, our 403Bs, 401Ks, 457s, deferred comps, that type of thing, where we are kicking the can down the road. We're not going to pay taxes today. It's going to be down the road after the taxes, after the portfolio is growing. And then basically at the very, very last one, the one that we like, are accounts such as Roth IRAs, some life insurance, municipal bonds, where you're not paying taxes, it grows tax deferred. And when you pull the money out, it's also tax free. That's always nice. So we love that third bucket. The third bucket, again, is the tax free, tax deferred account, which would be a Roth IRA, for example. So those things are very, very powerful. And one of the things I say to a lot of baby boomers that I have in class, I say to them, could you imagine if you were able to do a 401k Roth your entire careers, how much money you would have and how little taxes you'd have? And they all, shake their heads like, man, where was that when I needed it? Right. So, these are things that I'm telling the younger folk out there that are listening, get in your Roths, get in your 401k Roths. But for those people listening that have 401ks, they've built up a nice nest egg. Usually it's the next biggest thing to their house. These are times that maybe we could be looking into some Roth conversion while taxes are lower. We know what taxes are today. I don't know what they're going to be. They could even change in 2024. We don't know. But right now, this is the opportune time. But you have to explore it, right? And look at what it's going to cost and what it's not going to cost.
Yeah. And Tim, you mentioned it. Great for younger savers and investors to start or continue their financial progress with this in mind. And he sort of touched on this, but I want to go back to it and talk in more detail. If we are a saver who has already built and amassed and grown a decent tax deferred balance, we shouldn't be kicking ourselves for that in any way. We shouldn't be regretting those decisions, but we should be proactive in managing that tax liability today. We've got a window of opportunity.
Right. If you have an opportunity to do some Roth conversions under the current income tax laws, paying these lower taxes that we haven't seen in umpteen a million years here, this is a good time to be doing that. But at least explore it, and we have a great report that we can show people, if you do this, this will happen. If you do it the other way, you might be paying more in taxes. So, at least explore it. Give us a call. We can run the report for people. We're happy to do that.
800-640-2256. That's 800-640-2256 to see your proactive tax management report on your specific circumstances, your account balances, a few assumptions that you can discuss and decide on as far as rate of return and growth on accounts, tax rates and brackets. All of those go into this. So it's a very specific, individualized report showing what your likely tax liability will be if you default to the IRS's plan versus if you are a little bit more proactive. And again, if you'd like to see that report for yourself to make some informed decisions on how to manage your taxes, pick up the phone and give Tim Stearns a call, 800-640-2256. That's 800-640-2256. One of the big discussions, Tim, this year with the passing of Secure Act 2.0 is the fact that once again, the IRS has pushed back the required minimum distribution age. This is where they begin forcing you to take money out of retirement accounts so they can collect their yet to be paid tax bill that is right there within your balance. But they've pushed that age back now twice, and it will go back even further. Question to you: just because we can defer our RMDs for a little bit longer, does that mean that we should defer making withdrawals or being proactive with that IRA balance?
Being proactive with the balance? Absolutely not. You should be proactive. Think about the opportunities that you have here to maybe convert some of that to let it grow during your lifetime, tax-free. And when you pull it out, tax-free, right? So these are great opportunities that we have right now. Being proactive is never a bad thing, no matter what you're dealing with. So get ahead of it and at least do the exercise of looking what that entails for you as a household. It's not for everybody, but it is for many. And I see a lot of people do that, and it works out for the best for even your family. If God forbid something happens to you and your spouse, your children will still get that money tax-free from the Roth conversions. Of course, even with the Secure Act, they're going to have to drain that within 10 years, but it's still going to be tax-free versus a lot of people. If you pass while your kids are in their earning years, the last thing they want is more income and getting a tax bill from their parents from the grave, essentially.
Well, once again, if you would like to identify more proactive strategies to manage that tax liability, both on those retirement accounts during your lifetime and generationally, if you want to make sure that you are being as efficient as possible, pick up the phone, give a call. Tim Stearns will put that together, the tax comparison report, as well as that is included as part of the Protect and Grow Written Retirement Income Allocation Plan. Yours on a complimentary, no cost, no obligation basis as part of the review and strategy session just by calling 800-640-2256. That's 800-640-2256. Tim, aside from the IRS, I think being very aware that as our account balances grew, so did the tax revenue that they would eventually collect from those accounts. But in addition, there are some double and triple whammies in retirement that I don't think are well known or talked about nearly enough for what that income could create as far as consequences for even further and higher taxes or costs in retirement.
There are a couple double whammies. For example, when you're taking out Social Security, you can get taxed on that again. Remember, you've paid into it, you finally get to take it out, and then you can get taxed again. That doesn't seem great. at all to anybody, but that is something that's going on out there. You also have the effect that came out about 4 years ago called IRMA, which IRMA is basically a Medicare surcharge for people that make too much money in retirement. So Medicare is saying, hey, Joe Blow, you didn't put a lot of money away and you don't make a lot of money during the year. So your bill is, let's say, $150 a month for Social Security, versus, Jane Smith over here put money away. She gets a pension, she gets some Social Security, she's in a higher tax bracket. So her bill is going to be, I just had people in the other day, $700, for just the wife, because she makes so much money in the pension she's at. So those are the double whammies that we see. So, another reason to look at maybe doing some Roth conversions so you're not getting hit with higher costs, means testing basically for Medicare.
So there are consequences, and they can extend beyond just the taxation of your retirement account. Ladies and gentlemen, you have to be well-versed and think through and discuss the implications on your Social Security income and those health care costs and expenses. Your Medicare premiums can also be impacted. Also part of the Protect and Grow written retirement income plan that Tim Stearns, CFP, helps his clients put together and makes sure that you have in place. As being a listener to this program, if you have saved at least $500,000 for yourself, for your retirement, if you have that in investable assets or retirement accounts, pick up the phone and give Tim Stearns, CFP, a call for your complimentary planning review and strategy session to get that written Protect and Grow retirement income allocation plan. 800-640-2256. That's 800-640-2256. So, Tim, there are some strategic opportunities that we want to talk about. Did want to hit on a couple that we do still have open and available to us for last year. If we have not maxed out our IRAs, or maybe even better, our Roth IRAs, still time to do that. And maybe we could even double up on that for last year and this year, or double, do that for ourselves and a spouse.
Peter, what you're saying, though, is that we still have the opportunity till April 18th, because of how the 15th falls this year, to put money into a Roth, which is the one we prefer, but also an IRA if you need a tax deduction. Maybe you have some money sitting in a checking account that's not doing a lot. You feel like the market is kind of at a low, it's going to grow, et cetera. These are some good opportunities, but you can also do it for your spouse. So you and your spouse can do a double IRAs or Roths for both years, 2022 and 2023, and you have until April 18th.
And speaking of 2023 opportunities now, those limits have increased. So we've got a little bit more room to make as much of our money as possible and get a little bit more saved and supercharge up those retirement accounts.
Right. They are all indexed for inflation, which is excellent. So, depending on your age and that type of thing, you can have catch-ups, but there's a whole slew of things that you can do up until April 18th. So you're going to want to take a look at that and give us a call. We can help you with the deadlines and setting those up and that type of thing. We're happy to do it.
Now, if we have been an avid saver and investor and built up those retirement accounts, Tim, and are in good enough shape where we may not actually need them for income and for living expenses, and yet the government does have their deadline and their required minimum distributions, RMDs. Another great strategy, if you're charitably inclined, perhaps, are QCD's, qualified charitable distributions, which, by the way, even though RMD age has been pushed back, you can do the qualified charitable distributions still starting at age 70 or 70 and a half, correct?
That's correct. And what that means is that you can actually make a donation to a charity, obviously, and it does not count against your income. Our CPA really likes that as an opportunity. If you don't need the money, you're giving something to someone, and you're also getting, you're getting the money out of your estate, for example, or you're also getting the money so that it does not get taxed to your income tax.
And Tim, speaking of estate, I know that a lot of people talk about estate taxes, death taxes at current levels. There's only a select few that are actually going to encounter that. But for those folks, and maybe some that aspire to get to even close to that wealth level, those estate tax thresholds are also scheduled to come down significantly.
Yep. Yes.
And there are proactive maneuvers that you could make now to potentially control that, correct?
That is correct. And our estate attorney helps our clients that have that issue. So what you're talking about is the estate tax also at the end of 2025 will reset, as they call it, down to $5 million, which is going to get a lot of people out there in Chicagoland, right? I mean, if you look at your estate. So these are reasons that we tell people, make sure you're talking to a estate attorney in that example, or conversions, you're talking to a CPA, or you're talking to an advisor like us that can put you in touch with the people that are on our staff to help with those questions.
Important considerations, ladies and gentlemen, whether you are saving and investing and making progress toward that retirement, or you are well on your way and you've built up a good balance, or you are looking at how to best transition and transfer wealth and be as efficient as possible. You need to have tax planning, proactive tax guidance in mind, and identify the strategies that are right for you and your situation and your goals to be as efficient as possible. Pick up the phone, give a call to Certified Financial Planning Professional Tim Stearns, CFP, for that complimentary Protect and Grow plan for your retirement, for your income allocation, how to make the most out of each and every dollar and be as efficient and effective with it as possible. The Protect and Grow plan, the proprietary plan that you can only get there at TJ Stearns Inc., yours on a complimentary basis. If you have saved at least $500,000 of investable or retirement assets, give Tim Stearns CFP a call now. 800-640-2256. That's 800-640-2256. Tim, as always, important need to discuss information in our planning, and we always appreciate your perspective on things.
Well, thanks, Peter, for having me. It was my pleasure.
Tune into Chicagoland Certified Financial Planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.